Hey, what's up, YouTube? Welcome back. This is your boy Black Wall Street, aka Big John, and got a question for you. Have you ever heard the old saying, "Money don't grow on trees"? But it's not exactly true. So stay tuned, and I'm gonna show you how you can pluck money from a tree every 2 days. Subscribe to the channel so that you can learn how to fire your boss. That is the mantra here. Let's fire your boss. If you're not comfortable with firing your boss for whatever reason, maybe you're not really sure how to establish an LLC or open up a business, banking, your checking account, and file for an S corp. You can contact me, reach out in the comments. I can tell you how to set that up. And I can also tell you what you need to do to get group health benefits and things of that nature. But if you're just not comfortable with that, maybe you want to just hedge your current income. But here we learn how to fire your boss. So without further ado, let's get into the video. Okay, so there's two stocks that I'm working with right now. The first stock is SPY, with the market value currently at 433, and QQQ. The example I'm using on here today is QQQ. Both of the strategies are the same. QQQ is currently trading at 359.4.45 thereabouts, plus or minus. And then the strategy is a vertical put spread. If you don't know what a vertical put spread is, then I'm going to cover it just a little bit in the video, but that's not the point behind the video. It is and it isn't. All right, so I'm going to cover the vertical put spread. The vertical put spread, or bull put spread, or put credit spread, all the same thing. That's what it's called. So when you decide to implement the vertical put spread, that means you have a bullish opinion about the market, or at least the underlying stock that you're wanting to trade. I have a very bullish opinion on both SPY and QQQ. Now, if you've been watching my channel, you know that I have two trading accounts. One is Charles Schwab, which I will put a link to that in the description. Charles Schwab. And then the other is Robinhood. The other account is Robinhood. So I think a lot of people trade on Robinhood, but we're not going to get into that. So Robinhood, and I do apologize if you can't really read it. It's not very easy to write with a mouse, but it is what it is. Back to the vertical put spread. So with the vertical put spread, it is a strategy that is used to generate income. There's multiple different ways. If you looked at some of my earlier videos, I told you you should try to create different strategies so that you have a big payday at the end of the month and not focus so much on trying to get a weekly payday, but you want a monthly payday. Now, that strategy works whether you have a current job or you have a part-time job. If you for this strategy to work for you, one, you need to have some money discipline. Like, you can't be the type person who spends all the money. Every time you make money, you just spend the money. That's not how this should work. But if you are like that, just know for you to be successful with this strategy, then you're gonna have to get some discipline about you and wait and collect your money over time so that you can really see where your money is going to go. Because when you're trading options, the market is not always going to be nice to you. I lost money earlier. I mean, I'm never going to make that money back up, even though I made my position look a lot better, which I will be, I'll be posting, putting some things up here, some screenshots or whatnot. But at the end of the day, I did lose money. And that's on the last video that I posted. I talked about that. I lost $493. Okay, so with the vertical put spread, so when you go to your options chain, it's going to look something like this. You're going to have your strike prices over here. So these are your strike prices. Okay. So these are your strike prices. And these are your expiration dates. So the day is the 16th. And then, so over the weekend, it's going to be a 3-day gap, thereabouts. So in order for you to do this, there's a few things you need to have. You need to have enough collateral. You need to have enough collateral in your account. You need margin. You need a margin account. And most margin minimums are going to be about $2,000. So you need $2,000. You want to have a little more than $2,000. I suggest $2,500. And the reason I suggest $2,500 is because you need the 500 just in case you put on an option trade, you go to the video, you don't really do your due diligence, and you just want to pretty much do something that you saw me do, and you're gambling like that, which I strongly advise against. You just get in contact with me and we can set up a Zoom call. You can say, hey, I want to get in touch with you. Leave that message in the comment. I will promise you I will respond to you. If I don't, just be patient. I am a doctoral student, so I am busy, but I do go and check and see if anybody commented on the videos. And if I see this, I'm going to answer your question and I'm going to get back out to you. And I will put you in training and teach you how to do this, teach you about options, teach you the strategies I'm willing to teach. Like right now, it doesn't cost you a thing, but here pretty soon, I'm going to have a Patreon and it will cost you to learn what I'm trying to show you right now for free. Okay, so with that being said, so you need about $2,500 and the $500 in case the market changes opposite of the way you want it to go. And you need to close the position out. You need to have money available to close the position out because these trades, I like to put on a 10 lot trade. I don't see the value in just doing one option spread. Like I'm not interested in making $9. I'm just not. I'm not at all, because I do this for a living. I don't have any other job. I'm a student and I trade options full time and I work out and I train a fighter, which I am gonna start doing some video vlogs and let my followers come in a little bit more into my life outside of just me making these videos about what I do as a trader. Okay, so going back to the option chain. So when you set up a vertical put spread, so what you want to do is you're going to create what's called a credit. And the way that you create that credit is by selling close to the money and then buying long out of the money. And the difference between the strike prices creates a credit. And that credit, you will receive that credit, all of that credit, should your option expire out of the money, expires worthless. And that is the goal. So for you to accomplish that goal, you want to buy close to the money, but you need to be able to read the technicals and know that this stock is not going to drop below your short position, because if it falls below the short position, then you are at risk of being assigned 100 shares and you don't have the money to receive those 100 shares, at which case you would have to exercise your long position and negate everything out. So I chose the strike price of 357. So I sold the 357 and then I purchased the 356. And that gave me a credit based on the prices when I set this trade up of about $180. Everybody with me so far? So they gave me a credit of $180. I received that credit up front. Well, it did not give me a credit of $180. It gave me a credit of $18. But like I said, times 10, because I put on a 10 lot position. I don't do one. I don't do just one option spread. I do 10, at least 10, sometimes 15 to 20. And that's why I've got these down here, because these are going to be 20 spreads when I put those on. So that cost me a collateral. That had my collateral to where it's like 1,000. One of us say it was like $1,000, because there's only one strike price difference, so it's $100 for the difference. So and it's 10, so that's $1,000. And the same thing with QQQ. I purchased the 430, and then I sold. I actually purchased the 430, and then I sold the 429. And so that cost me another $1,000 in collateral, but I'm not going to put that up here because we're working with QQQ right now. Okay. So currently the stock is trading at $359.45. So if these are my strike prices, so I'm long 357, I'm short 357, I'm long 356. So that's fine. I'm in good shape. With the stock trading at 359, and we only have like an hour into the market closes. This is a safe position. My options are going to expire worthless. So I'm just going to let them expire, and I'm going to get to keep this full $180. My collateral that I put up to put this trade on will be refunded back to me. And I would have grown my account 100 plus percent, 100 some plus percent, about right around 78, 90%, something like that. Okay. So right here, you see me like, so that's for the day. So that's in this account. So I put the exact same trade on in the other account, and the numbers are still going to be the same. I put the exact same trade, same strike prices, the same everything. So in the other account, so on this one, I'm looking at 300. I'm looking at 160, 180. And then on the SPY, I'm looking at about $180, $190. So if you add the two, that's 180 plus 190. So that's $370. Now, I just told you that I put the same trade on in both accounts. So we multiply that by 2. Okay. And when we multiply that by 2, that's $740. So at the end of the day today, between two accounts, I will have $740 that I made just today. Now the strategy for the next days is to make $600 in one account, $1,200. So let's just change it to reflect that. So since you know that I'm using two accounts, these numbers right here should be $600 in one, $600 in the other one. So $1,200 should be these gaps right here. So 600 all the way across, right? So there's going to be 12, 12. So 12, 24, 36, 48, 60, 72, right? So $7,200 is what I plan to make by July the 30th, actually October the 2nd. Well, yeah, at the end of the day, July the 30th, $7,200 plus the $3,800 that I've already made between two accounts. for a total of $11,000. So I'm tracking $122,000 for the year. And it's rough. And then you figure the taxes is going to be about, it's going to be short gain. So it'll be about 22% taxes, but that's neither here nor there. And there's a whole nother video about how I avoid paying all that by utilizing my business and my S corp. Okay, so with that being said, so in order for you to do this, you're going to have to be able to read the technical analysis. You're going to have to be able to look at the MACD. You're going to have to be able to use your indicators. You're going to have to learn how to use not only the MACD, but you need to use the relative strength index, and you need to be able to understand patterns. You need to also know what the implied volatility is. Theta is not like a really big thing. When you're doing short positions like this, where you're not going to hold it but a couple of days, this is the most important thing to you, is the implied volatility. Because if you don't understand the implied volatility, which we can talk about that. So for you to understand the implied volatility, you need to know how to account for it. So whatever the current implied volatility is in percent, you need to multiply by the current price of the trade. And then the number that you get there, move your decimal point over 2 places, and you plus that to the current price and subtract that from the current price. And that is how much that stock, that underlying asset, can move in over a course of a year. And then you can take 365 days, divide that into that number, and that'll tell you about how much it can move in one day, which is going to be about $3 to $4. So you need to know you need to be aware of any catalyst that can make it move $3 or $4 down, or any catalyst that can make it move $3 or $4 up. Because just like you can put on a put credit spread, if you have a bullish opinion about the market, you can put on a call credit spread, call vertical spread, or vertical call spread, or a bear put spread if you have a bearish opinion about the market. So bull put spread, if you have a bullish opinion, meaning you believe that this asset is either going to trade at the same current price or it's going to go above, but it's definitely not going to come down. And that means you have a bullish opinion on the asset. Or if you have a bearish opinion on the asset, meaning that it's going to trade at the current value or lower, then you don't want to use a put credit spread on this. One of the first mistakes I ever made when I first started doing this, because I did teach myself how to trade options. I've never been a stock broker at all. I taught myself how to trade options. By one of the people that helped me do this was Brad Finn. Shout out to Brad Finn. He does an excellent job. He's actually a physics teacher. I think he's somewhere out in California. I'm not really sure, but he does a great job explaining this. So if I'm not doing a really good job of explaining this, and I've been told, I learn things fast, and I dig and study, and I really put that work in. Outside of here, I've stayed up plenty of nights trying to learn how to do this on my own, because it was really important to me that I no longer depended on anyone else to create my way. I wanted to create my own way, or depending on someone to hire me for a position in their company. I just wanted to work for myself. And Brad Finn, you helped me accomplish this. So shout out to you. And there were some others, but Brad Finn was probably the most, he was the one who really broke it down and really made it make sense. And he just taught me a lot of things. And then I added what he was teaching me along with what I was learning on my own. And I found a strategy that works for me. He likes doing the wheel strategy and leaps. I don't really care for that, because I don't have a job other than trading options. So I need to create a monthly income all the time. And I think you can do that with the wheel strategy. I have learned how to get assigned on the putts, so that I can actually go and sell cover calls against those. But still, you're looking at delta. You got to figure delta. You got to understand theta time decay. You got to understand the Greeks very, very well, which I do, and I know how to do the strategy. However, it does not pay off in the frequency that I needed to pay off in, and so I just choose not to do that. I much rather do this. So going back to this, so we know that the position is safe here. So how can you get in trouble in this position? The main place you can get in trouble on this position is not choosing the correct strike price. You want to get far enough away from the money to where it makes sense for you to put the trade on and be safe, so that there's no way, based on the implied volatility, that this option is going to move against you. The only way you can be certain about that is for you to do your fundamental analysis. That means you need to listen to Bloomberg. You need to read Yahoo Finance. You need to study, go to bar chart and read any news, CNN news, Money NBC news. You need to do your due diligence and make sure that there's no catalyst where this, because if this asset drops in between here, okay, this is your short position. This is your trouble, because the intrinsic value on closing day of your long position, which is the 356 strike, farthest away from the money, then this is where this is going to have no value. There's not going to be, and remember, the intrinsic extrinsic value of the asset is going to be considered the price. So it's worthless. It doesn't have anything. So if you try to let this expire and it's dropped to 357 even or 356, you could be assigned 5 minutes before the market closes. And now you've got a problem, because if they don't get to it by the time the market closes and you've been assigned, you have absolutely no protection. You are out here by yourself. That's why there are other things that you need to do before on the day of closing, like close these spreads out. I'm not going to close my spreads out because my spreads are not in any trouble. I'm going to let them expire worthless. I don't see how I can get in trouble, but I will check it again 10 minutes before the market closes. Why would I do that? Because things happen. I'm not going to sit here with 30 or 45 minutes left, or however long I have left, and just say, okay, that's it. That's not how this works. If you're working for yourself and you're doing this, then you're going to be, you at that point, you are a professional options trader. That does not mean you're an option expert. That means you're a professional options trader. You do this to collect money. Think of it like an NFL football player. The difference between a professional football player and a college football player is not necessarily skill. It is the fact that one does not get paid, this one does. Same like an amateur fighter. This guy can fight just as well as this guy, but this guy said, I want to get paid, so I'm going to declare myself a professional, and I get paid for my craft. Same thing with options trading. You get paid, you're paying yourself based on the decisions that you make and how you handle your positions in the market. So you need to hone in on your craft. That means you know better to just sit here 30 to 40 minutes and say, we're good. No, you don't necessarily know that, because something can happen and then it moves $3 or $4 against you. Now you have a problem. So you went from $200 that you're going to collect from each account, or they're close to where you're losing a lot of money on one account when you could have just closed the trade out. So 10 minutes before the market closes, I'll go, before I even start messing with this video, doing any editing, adding any music, anything like that, I'm going to go and check on my positions and make sure that it hasn't moved against me. Check and make sure, do I need to go ahead and close these spreads out and collect my premium? Okay. So right here, and also I'm going to go and I'm going to set up my 7/19/21. I'm going to set up my next trades. And guess what? There was no catalyst this morning when I woke up. So this morning I woke up, got my cup of coffee. I fixed me some yogurt, some grapes, and didn't use any sugar, no cream, just black coffee, some sugar and some grapes. And not sugar, but some grapes and some yogurt, low-fat yogurt. And I was sitting here, I did my studying. There's nothing in the market that says there's a catalyst around. So I'm going to use the same two stocks. I'm going to use QQQ and SPY again. And I'm going to choose the strike prices that put me in the best position to win. and I'm going to put on a 20 lot so that I can collect $600 once the option expires on Monday in each account for a total of $1,200. And then, so while this is expiring, Monday morning when I wake up, I'm going to start studying the market to see if there's another stock that I want to use or if I want to keep the same two. And I'm going to start working on Monday for what I'm going to do on Monday evening when I set up the trade for 7/21 expiration. And I'm going to keep doing that until the end of the month. And then I hit this goal right here. And then we're good. It's not as hard as you think it is. Once you understand how this works, you understand that your trouble spot is right here. Whenever you sell at the money, the strikes at the money, they lose extrinsic value at a much lower rate than the ones in your long position. Your short position is always your trouble. Even when you do your iron condors, your short position is your trouble position because it's closer to the money. Any strikes that are closer to the money lose extrinsic value at a much lower rate, which than the long positions, and that's where your trouble is going to be. So using the vertical put spread. So let's recap for a minute. If I wanted to do this just to, let's say, have some extra income, there's nothing wrong with somebody reaching out to me in the comments and say, hey, I like this. I think I want to try this. I want to learn more about options. Then we can start at square one. I'm going to teach you about the Greeks. Then we're going to learn the definitions, like what is a put, what is a call, what is a secured put, what is a cash cover, what is a cash cover call, what is a poor man's cover call, or a leap, same difference. What is a vertical put spread? What is a vertical call spread? When would I use a diagonal? I don't recommend you using it. What about a strangle or a straddle? No, there's other safer options out there that's not going to expose you to much, give you much market exposure to where you're going to really, you have an ability to lose money. Like iron condors, iron butterflies, call butterflies, put butterflies, all of these different strategies to where you can make money. And but this right here, when you know that the market is not that hard to read, and the market is bullish, or the stocks that you want to trade are bullish, you want to put on a bull put spread. The bull put spread is an excellent way to make this monthly income. But I also showed you in another video where you can do the same thing with an iron condor. You can do the same thing with a short iron condor. You can do it with an iron butterfly, which is also a short iron condor. You can do it similar with a directional butterfly. But right now, I'm not using those strategies because I do have a couple of people that have come up under my tutelage, and I don't want to put too of an advanced strategy out there for them to try. And because when you start doing directional butterflies, you need to be really good at reading technical analysis. You really need to be able to read the chart patterns. You need to be able to read the bullish indicators that can be given to you in the MACD. You need to be able to understand the 20-day, the correlation between the 20-day moving average and the 200-day moving average. Has it crossed? Like, has it crossed from the top? Has it crossed from the bottom? These are things that you need to know so that you can have a proper outlook on a specific asset. So recapping, vertical put spread is good for establishing income. You can actually establish a money tree, especially with these two particular stocks. Not all stocks have expirations that play out like this, where 719, 721, 723, 725, 728, 730. Not all stocks have it, but these two stocks in particular, they do have it, right? So you know that you're going to need collateral, for to have a margin account. And the reason the margin account instead of a cash account, you don't have settled funds. So you could put the trade on if you have level 3 options trading, which that's another thing. Let me write this down. So you also need to be approved for level 3 if you're in Robinhood, and you need to be approved for level 2 if you're in Charles Schwab. And I can tell you right now, Charles Schwab is not going to approve you for level 2 when you first start. You can forget it. You either know what you're doing. They will ask you questions about the positions, how to set up a certain strategies. Do you understand these strategies? Do you understand how to keep yourself from being in trouble? Do you know how to roll the position? Like, do you know how to close the option spread out? Do you know how to adjust the iron condor? Do you know how to hedge the iron condor? But these are the things that you will learn when you start working with me, because I'm going to teach you that. I'm going to teach you how to mitigate risk even further. So what happens if the market does go against you? Then you'll learn how to either close down the position that's winning money, because you can't be bad in two places. Like if the market is going against you and you had a bullish position and you're setting up an iron condor, it's either going to go up and away from where you need it to be, or it's going to fall below where you need it to be. And you can always close off the side, collect some premium, and then close the other side down, or reposition the legs, which I'm not going to get into that on this video. That's something that we would do in a one-on-one if you get in touch with me in the comments. So with that being said, if you don't have any questions, let's end the video right here, and let's get that money, and let's work on firing your boss. On track, now we gon' way up. W's as easy as a layup. Working late, stay up.